Hi everybody, welcome to another update on the stock screener. Today we're going to talk about Gold Mountain mining, which is another gem that I found, and I've bought some, not a lot, but you tell me why I shouldn't buy this company. So this company has shot up from 0.1 to 0.2, so that's 100% in one day. So why is it shooting up 100% in one day? So they have provided an update, and probably this is the reason why it is going up. So the company reported that they have 2.3 million revenue in January, and which is an EBITDA of 700,000. So that's about 30% of that. 30% margin of operating margin, not bad. And here they say that the production is 1,160 gold with some silver. Okay, so if you do this times the gold price, that's about, yeah, I think it will be about this revenue. So that's about 14,000 ounces per year. If you, this is for January, so times 12 will be around 14,000 ounces per year. Okay. Then we have costs of 1,100 AISC. So this is a very good cost. It's a great margin. We have 1,800 gold with 1,100 costs. So this company can make money if they can keep on producing this amount of gold at these costs. And they say that they have improved grade, so that's also good. 6 grams per ton is the head grade, so that's a very high grade. I think in the past months they only had 3 grams per ton, so this is a great improvement. So they have seen improvements, and the success is attributed to improvements to drill and blast design and ore control processes. So this is an improvement in the whole process. So I expect that this will continue in the future, and let's see if they can do that. Now in February, they said that there were some impacts on weather conditions, but the improvements continue. So that looks good. So this company went up by double, but it's still cheap because when you look at when they started in 2022, it was at $1.6. Now it's at 0.22. So it has crashed down. So it's actually very cheap at this moment to buy. And let's take a look at the valuations now. So market cap in million US dollars is 17 million. The book value is 27 million. You can find that here. 37 CAD, that's the equity, and that's about 27 million US dollars. So this is trading at only 65% of book value. And the balance sheet looks good because it has a lot of cash, 7 million current assets, and current liabilities are 6 million. So they can pay the current liabilities, and there is not a lot of debt. There's actually no debt in the non-current liabilities. So that's good. Clean balance sheets. They have profits right now because of the new improved processes. And let's see how much profit. So fully diluted 109 million. PE ratio is, I think, around 5, which is a good company. It's a low PE ratio, and they also have growth, as we will see later. So look at the resources. They have 1 million measured and indicated plus inferred, 1 million ounces of gold. So if this were an explorer, then I would give it a 30 million market cap value. Currently only 17 million. So that's already undervalued based on the resource alone. And the grade is high. It's around 7 grams per ton, as you can see here, with high gold recovery. So all good balance sheet, has earnings, has a lot of resources, 11-year mine life, but that's at 65,000 production. Currently, we are only at 14,000 production. So actually, they have 70-year mine life right now if they continue to produce at this number, but they are going to increase production. So currently, we are only at 14,000 production, right? So it will ramp up to around 19,000, as you can see here in the first 3 years. So 14,000 will probably even go to 19,000, like this. And then it will progress to 65,000 in the coming years. So there's plenty of growth in the future. This is from 2025 onwards. And they are still already profitable and undervalued with PE of 5 currently. So it can only improve. Now, we also look at the CAPEX, of course. What is the CAPEX to increase this production? Now, look at this. Initial capital cost 9 million. So very cheap CAPEX to get to this production. And this is 7 times, no, it's, it's about 4 times current production, right? So production will increase 4 times from the current production. And not only will production increase, the costs will decrease. So currently we have a cost of 1,100 AISC. We'll go to 1,000 when they go to 19,000. And we'll go even lower to 500 in 2025 when they hit the 65,000. And you can see that here AISC is going from 1,000 to 500. So increase production, decrease costs. That's what I like to see. And I think they can do it because they are profitable now. So based on this. So here we are in the expansion phase. They are starting the permitting for the 65,000. It's not permitted yet, but it's just an amendment to the permit. Now the amendment of the permit, you can read that. Do I have some data about that? Oh, here it is. So the BC Environmental Assessment Office ruled that company would not need to obtain an environmental assessment. Okay, so that's good. So they only need to amend the current permits. So that's good news. So they just need to amend the permit and then they can go to the 65,000. But even if they don't go to 65,000, they can still keep on producing at this rate, right? And in 2025, they will get to the 65,000. So for the first 3 years, they will produce 19,000, and that will go up fourfold. Okay, let's look at the financials. So I charted this out. Revenue went up and down. Here they had some problems probably. But now look at this. This will be the projected revenue, which is the highest since they started production in the last year. And here you can see that the net profit went negative and now will probably go back into positive. So the company is actually doing great right now. Good balance sheets. They have profits at a good profit margin, low costs, and starting to increase production. This is the valuation metric, which I use 5 times EBITDA. So this point here is this. So here we use the current AISC with the current production, and that gives me a valuation of 50 million US dollars. Currently only 17 million market cap, so there is upside. This point here is using the 19,000 production with 1,000 AISC and gives me 70 million valuation. So going from 17 to 70, that's a triple. So there's a potential triple on the phase 1 alone. So this is the phase 1 for the first 3 years. And then in the future, we can even go to this point here, which is the 65,000 production, which happens in 2025. So plenty of upsides if you hold this long enough, from 17 to call it several hundred millions of dollars. And this is also confirmed by the NPV here. NPV with 5% discount at 1,800 gold gives us hundreds of millions of dollars in net present value. So good project, only 17 million market cap going to 100 million in net present value. So that's, it could 10x from here if this pans out, of course. They still need permits and they need to make sure that operations go well. But looking at this, it's going well with good costs and they are producing at good grades. Okay, so everything looks fine. Let's take a look at presentation. Very cheap price to net asset value, very low enterprise value to production, very cheap. They are selling their gold to New Gold. It's in British Columbia, so not bad political risk. This we already saw. They are actually going to update the resource and send another PEA out, so we will look for that. Production growth, resource growth, 1 million ounces of gold, so we are undervalued based on this already. They are selling to New Gold. So this is the property, resource. We already saw this. Look at the AIC, very cheap. Holders, Prescott Capital is apparently in here. A lot of insiders. So this is actually a good company and not a lot of warrants, maybe 20%. So I used the fully diluted share count and it's still very cheap. Good resource, very high grades, 6 to 10, and it's about 1 million ounces. So undervalued based on the resources alone. And here you can see some other metrics. So try to buy it. It could retrace down because it went up 100%. So, and apparently it just went up while I made this video. So apparently people like this story and see that it's undervalued. Could easily double from here. But that also depends, of course, on this here. Can they keep the costs at 1,000 per ounce? And can they keep the head grade at 6 grams per ton? These are the main questions. If they can do it, then this is a buy. And I'll see you in the next video.